Thank you for the kind introduction and a very good morning to all of you. I thought I'll begin with a brief background on the activities of pension funds, especially the investment activities of pension funds. Because this has a bearing on economic development and growth generally. Now, if you see globally, the role that the investment activities of pension funds plays in economic growth and development is quite significant. And in fact, if you look at countries like USA, the developed countries like USA, UK, Australia, Canada, the amount of pension assets in those countries is more than the GDP of those nations. Just to give you an example, in the case of USA, the pension assets are about $21 trillion, which is, and the GDP of USA is about $15 trillion. So, and likewise, in the case of other countries like UK, Canada, and Australia, where the pension assets are higher than the GDP of those countries. So, very clearly, pension assets contribute very, very significantly to the growth and the economic advancement of these countries. The position is a little different in some of the emerging markets, especially in the case of India. In India, the GDP, the pension assets to GDP ratio is just about 4 or 5%, and compared to about 121% in the case of USA and similar figures in the case of the other countries. Now, there are good reasons why the pension assets in India are much lower compared to these countries. Two principal reasons. One is that the pension coverage itself in the country is very, very low. In fact, it's abysmally low. Just about 12% of the population is covered by any kind of a pension or social security cover. Whereas in these countries, practically everybody is covered by either a pension scheme or some social security cover. So that, because of the very low coverage, the pension assets are very, very low. And even in the case of the population, the population which is covered by some kind of pension scheme, till very recently, these pension plans were not funded plans. They came out of the government budgets, and there were no assets supporting these pension plans. So as a result of which, the pension assets in India are very, very low. And the other notable thing about India, as far as pension assets, pension funds and pension assets are concerned, is that the existence of the informal sector. And in fact, that's one of the biggest contributory factors to the very low pension coverage in the country. Now, in India, I don't know how many of you know this, but the informal sector accounts for about 86% of the employment in the country. Now, this is far, far higher than most of these other countries where the formal sector accounts for about 70 or 75% of employment. And this poses its own kind of challenges, for pension cover. Because when you have such a large number of people engaged in the informal sector, it's very difficult to cover them with any kind of a mandatory scheme. It's very difficult to implement that. And we've seen, even in the case of the formal pension, like in EPFO, we've seen the number of problems that they have in proper coverage. So even in the formal sector, we have these kind of issues. So if you were to extend pension coverage to the informal sector, a mandatory pension cover in the informal sector would be very, very difficult to administer and control. So that is one of the reasons why pension has not really taken off in this country. The government is very much aware of the potential of pensions towards economic growth and development, and therefore in the late 90s, the government set up a committee called the OASIS Committee. Some of you may be familiar with this name, OASIS Committee, to look into the whole issue of increasing pension coverage in the country. Of course, one of the principal objectives of the OSS committee was to reduce the fiscal pressures on the government on account of the pension payments arising on account of the pensions paid to civil servants and defense and things like that. So that was the primary objective. But this committee was also charged with the responsibility of seeing that the pension coverage in the country was widened. And they came up with a series of recommendations which are designed to reduce the fiscal pressure on the government and also put in place a pension scheme which would enable all citizens in the country to participate and be members of. So following their recommendations, this national pension system which we administer and the Pension Fund Regulatory Development Authority was set up. And one of the biggest, the most momentous decision which the government took at that time was to shift from the defined benefit pension scheme that was in existence then to a defined contribution pension scheme. This was a very, very big decision, and because it has its own challenges. Now, the defined benefit meant that the pension payments that the government was making till then came out of the budget, and with the number of pensioners in the civil service and defense rising by the day, this was proving to be quite a burden for the government. So there had to be a change there, and the government, by making the shift, the government changed the scheme from a defined benefit in which the government met the entire pension burden to a defined contributory scheme in which the subscribers, the government employees, the defense, not so much the defense, it's the government employees started contributing towards the pension plan. So this was a very, very significant, momentous decision. It was met with a lot of resistance because the government servants who are used to getting pension without making any contribution found it a little hard to digest the fact that from 1/1/2004 they would have to start contributing partially towards the pension that they would get when they retired. This was a bold decision, but it was taken and it was implemented. And from that day onward, 1/1/2004, all the contributions that the government employees made and the government also made, because it's a contributory scheme where the government contributes 10% and the employees themselves contribute 10%. All those contributions are invested in assets. So that's when the pension assets really started building up. Of course, before that, you had the EPFO also, which was investing in largely only, in fact, in fixed income securities and GSECs. But with the setting up of the PFRDA and the NPS, the focus shifted slightly from just investing in fixed income securities to equities as well. So this was a major change brought about from 1/1/2004. And it started off with the central government employees being included in the defined contribution scheme, which was introduced then, which is the NPS that we administer. And seeing the benefits, the fiscal benefits of this move, a lot of state governments also started joining in. And as a result of which, today, barring 2 states, every state in the country has become a member of the NPS, because they see the benefit of a contributory scheme rather than one pay-as-you-go or a defined benefit kind of scheme, which was in existence earlier. So this was a major move. So today, practically, a civil servant in the country who has joined after 1/1/2004 is a member of the national pension system, except for the 2 states that I mentioned. And the other notable thing that happened there was the fact that the national pension system was opened to private citizens. That came a little later, but it was the first scheme which was promoted by the government, which was opened for the private sector, the citizens of this country. So any citizen could join the NPS, and it was a purely voluntary scheme. And the voluntary nature of the scheme poses its own problems. But the fact that a government-backed pension scheme open to all citizens of the country started becoming available from 2009, and that opened the doors for wider coverage of people through a pension plan. Now, in order to boost coverage of the population with pensions, the government has been giving a lot of incentives and try to promote the scheme quite aggressively. So that's why you found that over the years, the government has been giving some tax breaks for pension schemes. And in a couple of this pension schemes that we run for the underprivileged sections of society, which was earlier we had this Swavalamban scheme. I don't know how many of you are familiar with that. And currently we are running the Atal Pension Yojana. Now there, Atal Pension Yojana, the government gives a guarantee of pension payable to people. So this kind of support is quite unique. You don't find that in many countries where the central government gives a guaranteed pension to people. And not only that, till last year, the government was also contributing towards participation in this scheme. So the government, in its own ways, has been promoting and encouraging people to join pension plans. And the results are good. Now we have, in a matter of about 10 years, 10, 12 years of our existence, we now have about 1 crore 42 lakh subscribers. And our pension assets are now about 165,000 crores. So it's been growing at a good rate, about 30-35% a year. And we expect the coverage to go even wider and have more and more people included in these plans. Now, one of the challenges I mentioned, in widening pension coverage and seeing increasing pension assets in the country, is that when you target a pension scheme at the informal sector, you have to keep in mind the characteristics of the informal sector. Now, the income levels in the informal sector are not very high, so their capacity to contribute large amounts is quite limited. And therefore, you have to design a scheme which is low cost, but at the same time, which fetches good returns, otherwise people would not join this scheme, being voluntary in nature. And it has to be a regulated scheme, because otherwise people would not have much trust in the scheme. So all these things have to be built in. And that's what, when the NPS was designed, all these factors were kept in mind. With the result today, NPS is arguably the lowest cost pension scheme in the world. And this has been corroborated by several global bodies like the World Bank and IMF and all. So we are probably the lowest cost pension producers in the world. The returns are as good as any you'll find in the market. And there are a lot of other features also, which were built in to cater to the requirements of the informal sector largely. So it does appeal to a large number of people, and the progress and the growth that these schemes have seen are a testimony to its attractiveness. Now, coming to the investment of these funds, because that's really what this conference is all about, the investment of pension assets and the investment in alternative investment assets. Now, we have over the years been constantly modifying the investment pattern for the pension funds which are invested in the economy. And we have over the years been introducing new instruments. And last year, we decided to open up pension funds for investments in the alternative assets. And we don't allow investment in all kinds of alternative assets. We allow investments only in certain assets like REITs, investment trusts, then asset-backed securities, mortgage-backed securities, things like that. So we did open it up last year, and we set aside a small percentage of 5% of the corpus to be invested in alternative investment assets. And the result so far has been quite encouraging. We opened it up just about, in fact, it really became available just about 3 months ago. And we've seen good response from the market. A lot of people are interested in putting some money in these kind of assets. One, as a measure of risk diversification, and also because of the high return kind of promise that these assets hold for investors. But there are a lot of challenges as well. And I'll talk about some of these challenges. And there are some challenges which probably the industry needs to ponder over and come up with some kind of a solution if the investment flows towards these assets are to increase. Now, one of the big problems that we currently face as far as these assets are concerned is the paucity of assets themselves. There are very few actually assets available in the market today. REITs, I mean, there's hardly anything available. The only alternative assets available today for investment are these asset-backed securities, mortgage-backed securities. And there too we have an issue. The minimum lot size is very, very large. Now, you know, in a fund like a pension fund, where you have regular contributions coming in, month after month, small amounts, everybody, you know, puts aside 10 or 15% of his salary, which goes towards the building up of the corpus. Now, these flows are not large enough for us to make regular investments in alternative investment assets. So, because the minimum lot size is very, very large. As a result of which, what has happened is that although a lot of people have shown interest, evinced interest in investing in these assets, they're not able to do so because the ticket size is so large. So this is one of the big problems that we are facing. We are talking to SEBI also about this to see if some solution can be found. Because everybody is eager to see pension funds investing in these assets. But there are some hindrances in the way which have to be sorted out. The other one is I think you mentioned about this investor awareness. Now, these are new assets, and many subscribers, many pension subscribers are not very much aware of these assets, you know, their characteristics, their features, their pros and cons of investing in such assets. So a lot of investor awareness has to be created. People have to be explained and educated about the benefits and the risks of investing in such assets. Because unless this is done, people will not readily come forward and do that. We have been, in our own way, trying to explain to people about the pros and cons of these assets. But I think the industry also needs to take it upon themselves to see that there is better understanding and better awareness of these products in the lay public. The other issue is about valuations. Now, these are all illiquid securities, and valuation is a problem. And when you have a kind of a pension scheme that we run, which is a defined contribution scheme, where the assets are marked to market on a daily basis, if the valuation is very opaque, then that does not create a very comfortable feeling in the minds of the subscribers. So valuation is another issue which affects our subscribers. And this is also something which needs to be looked at very, very closely by the industry. I don't know what kind of benchmarks or what kind of standards, valuation standards you can come up with, which will give some comfort to subscribers for investing in these assets. Liquidity. Liquidity is also an issue. It's not so much of an issue for us right now, because our schemes are still young. We've been around for just about, as far as the government sector is concerned, about 10 years or so, 10, 12 years or so. As far as the other non-government sectors are concerned, about 5 or 6 years or so. So we are still in the accumulation stage, where we don't see too many exits happening. But going forward, when people start retiring and start getting pensions, that is when we reach the decumulation stage, this could become an issue, because with these assets not being liquid enough, there could be an issue when if you have to redeem some assets and pay pensions out of them. And of course, the last one is the high fees. The fee structure, as I mentioned, we run probably the lowest cost pension scheme in the world. And while we don't mind the high fees that alternative investment funds charge, we would also like to see some high returns happening, because unless high fees are backed by high returns, people will not get in. And the track record so far, I mean, has, I don't know whether it's convincing enough to inspire people to invest in these assets. So this is also something that we need to look at. So these are some of the challenges that we face in getting people to put their money in alternative investment funds. And the industry seriously needs to look at some of these issues, because if we are to get people to put their money in these assets, then these issues will have to be tackled, looked at more closely and tackled. Currently, insofar as our funds are concerned, we have about 49% of our investment in government securities, about 35% in corporate bonds, about 12 or 13% in equities. Now, the reason why there's a preponderance of government securities and corporate bonds is that the investment pattern for the government funds is a little different from the non-government funds. And currently, government funds account for the bulk of the money that we manage. So theirs is a much more conservative approach. They allow only up to 15% investment in equities. They don't allow any investment in alternative investments. This alternative investment channel is open only for the non-government funds. So we are talking to the government to open it up to treat the government funds on par with the non-government funds. But that's something which has not yet happened, which may happen in the near future, because we are talking to them very closely. So because of this, because of the different investment allocations made by the government funds as compared to the non-government funds, there is a preponderance of government securities investment and corporate bond investment. I mentioned that we have been over the years making some changes, and one of the other changes that we brought in about a couple of months ago was introducing these life cycle funds. Life cycle funds are funds which adjust according to your age. So we have 3 life cycle funds. One is an aggressive fund where if you join at a young age, then a very high amount goes into equity, about 75%, and then it tapers off as you age. Then there's a conservative and another one where the maximum investment equity is 50%. So we have been making all these changes, and going forward, a really big change will come if, and this has implications for the alternative investment industry also, is if the government allows us to allocate their investments towards these assets. So currently they are not allowing that, but we are talking to the government, and if they do agree for that, then this will open up a big channel for investment in alternative funds. So this is the story about investment of pension funds in India. People are very much aware. The government is very much aware about the potential of pension funds in economic growth and development, and they are trying to promote pensions and give it all kinds of incentives and support to see that pension coverage in the country goes up. And we are quite hopeful that going forward, although we may not reach the levels that the developed countries have reached in terms of the the pension assets in the total GDP, but we are quite hopeful that we will definitely go up from the current low levels of about 4 or 5% to something like 10 or 15% in the next 5 or 6 years. So that is the hope, and as far as the alternative investments are concerned, I mentioned some of the challenges that we currently face. And since this is still we've just opened it up, so I think if we can take some timely action and address some of these issues, then going forward we could see much more flows going into these kind of assets. So I'll